And your shares are the meat of the trade. So you've made money all the way up. Now you're repositioning the trade and you haven't lost or won at this point, but it's costing you a debit to move it to this point. If it continues to go up, you're going to continue to make money. If it drops a ton, you're going to lose, and you was going to lose anyway. Let's look at Palantir. And let's say you have shares in Palantir or whatever company that you absolutely love, and you never want the shares to be called away or sold away. If you are the seller of a call, you have the obligation to sell shares. If you don't have the shares, then that's a naked call and you have to go into the market, buy the shares, and provide it to the buyer of the call. If you have the shares, then that's what is called a covered call. And it's called covered because you already have the shares. It's no risk to you to the upside. You do not have any risk to the upside because you already have the shares. But you might had the shares at a very, very low cost basis, like a break-even basis, and you do not want to pay taxes on it. Or you might think the stock is like Palantir and you think it's going to the moon, and I'm not being facetious, you literally think it's going to be just a 10 bagger that they used to say, just a significant outlier for you financially, and you do not want to sell those shares. But you also understand that stocks just don't go up in a linear fashion forever. They will go down, they will trade sideways. And so when they're going down and trading sideways and not going up a lot, which is most of the time they're doing something and not going up a lot, you want to make money off those shares that you own, right? Because you understand that at least 100 shares is like owning a property. And you do not want that property just to sit there and rot. You want that property to bring you monies back, because if it's just sitting there and you paying a mortgage on it or paying maintenance on it, then that's a liability. You want that property to be an asset, bringing you money. You do not want your shares to just sit there when they're just doing nothing, because at the very least, you're losing opportunity cost, because that monies could be working for you more effectively in something else. So why not sell calls against your shares so you can make some extra income on a weekly basis, monthly basis, quarterly basis, yearly basis, whichever time frame you decide that is available to sell. You're making extra money on your shares. But you don't want to sell it, right? You have a property on the ocean front and you want this to be in your family into perpetuity. And I'm being a little silly, but I'm just trying to illustrate you do not want to sell your shares. So what you can do. So let's say you have the covered call, and your call is now at the money. Okay? It's still 32 days to go and your call is at the money. Well, you can decide to roll it out, and rolling it out means you are doing something like this. I'm going to clear this so we can just show the call itself, because the shares are already there. Just imagine or just understand that the shares are already there. So whatever it's saying over here for max loss and all that kind of stuff, disregard that because you have the shares. Okay. Now, if it's at the money and it's 32 days to go for this example, and you want to roll it out, well, you can buy it back and you can decide to move it out. Let's say you decide you're going to move it out 60 days. Well, this is something that I told a member that did a one-on-one with me over the weekend, that you can just move it to the 15 delta, at or near the 15 delta. And so if you do that, yes, this is going to be a debit, but your main premise is that you do not in any shape or form want your shares to be called away or sold away. Same thing. So in this example, let's just say you're going to pay 668 to move it from 32 days at the 175 to move it to 60 days at the 220. The probability, if this is 15, it's saying it's a 15% chance it's going to expire above the 220. You probably already had it at the 15. So what are the odds on it continuously going above that 15 delta? Not very high, so you just move it back to there. But if it continues to go up, you have this 25 plus the 20, right? So you have 45 points to the upside. which is 45 times 100. That's the lot that you have to just say. So that's $4,500. This right here is 700. I just say I'm just rounding it up now from that 688 to 700. Minus the 700, you can still make $3,800 to the upside. And keep in mind, you have most likely made already more than 700 when the stock jumped up anyway, all the way to the call that you had to move. Yes, you're buying back the call for a debit. You're moving that for a debit, but it doesn't mean you've lost on the trade. You've technically have won on the trade already. Yes, are you paying a debit? Yes, but that doesn't mean you're not going to win or lose after this debit. It's just like buying the shares again. When you buy shares right away, if we were just going to buy shares right now, right this second, it would be a debit. But it doesn't mean we've lost or won. That all depends on what happens after that. Does it go down? Then we're losing, right? If it goes up, then we're winning. Same thing here with this covered call. You're moving it to a safer delta because you do not want your calls to be sold away. But it's like repositioning the trade. You still have the shares, you still won in the first expiration period because you were at the 15 delta. That's the example we're using. It went all the way up. It's now touching that strike that was at the 15 delta. Now it's at a 50 delta. And your shares are the meat of the trade. So you've made money all the way up. Now you're repositioning the trade and you haven't lost or won at this point, but it's costing you a debit to move it to this point. If it continues to go up, you're going to continue to make money. If it drops a ton, you're going to lose and you was going to lose anyway. But you still get to keep those shares. You still get to keep those shares. I can't stress that more. So this is one of the ways you can adjust it. Don't let this debit fool you. We talk about this with the collar a lot now recently. Don't let this debit discourage you. You've made money. Now, making money going forward all depends on this new trade. What's going to happen with the new trade? You're still bullish. If it goes up, you're winning. That's a fact. If it goes down, you potentially could lose. If it goes down a lot, you will be losing. But that's fine. It's not realized losses. It's all unrealized. If it's a great company and you are obviously consider it a great company because you do not want to sell the shares at any cost, at any price, so it will come back. It will come back. And especially if you're doing this on an index. You guys know I believe that. All
Brian,
right.
I have a question, and it was
Yes.
one that I was going to bring up earlier today, actually,
Mhm.
which was you've done the example as if it's really close to your initial cover call.
Mhm.
What would happen if it really flies past it and it's about 20 points above, which is a
So same
situation which
thing.
I've had with Shopify from 130 crashing through my cover call, and it's now at 142.
Okay.
So it did go up to 150, so I know that that's possible for it to do that again. But there's, I've been questioning whether just to let it go because it went so. I had my eye off the ball.
Okay. So let's take a look at Shopify. How many days to expiration?
I got till Friday.
All right. So let's say 4 days to go now. Okay. And what is your call at right now? What's the strike price?
It's at 130.
Okay. All right. So this is her call right here, you guys. It's
Yeah.
at a 94 delta. So what that means is that whatever she started this at, and then let's just say you started it at a 15, 20 delta, I'm not sure what you started it at, right?
Yeah.
But when you chose this strike, it was you were going to make money to the upside. You just didn't think it
Yeah.
was going to jump up this much. So you
20 points.
exactly. So
Or
you've
25.
exactly. So you said more than 25 points. So you've made
Yeah.
almost $2,500 at least to the
Yeah.
upside at this point on this trade because it's almost fully baked. As you can just say that semantics. It's fully baked because this is a 94 delta. So you've won money to this point. And I just say $2,500. I just use that as a number.
Sure.
So you don't want this to be call away, I just say. So what you can do is buy this back. And I just say you wanted to go back out to 32 days. Well, where do you want it to be at now? Right? And you said 150. So maybe you think it can go back there. Maybe you don't want to have any chance for it to go in the money again, or at least you're going to try to do your best for it to not to go in the money again. So let's say you sell this 15 delta now, right?
Mm-hmm.
So it's the same thing what I'm just showing right now. This is going to be a $1,200 debit. I'm rounding it up. Okay.
Mm.
You've made already $2,500 on the previous trade. This right here doesn't mean it's you now lost 1,200. This is a debit of initiating the trade. That's how you have to think about it because that's how it is. It doesn't mean you're going to win or lose yet. It hasn't played out, but this is a new trade. It's a new expiration period. It's a new trade. And if it continues to go up, guess what's going to be more powerful than this call? It's going to be your shares. You're going to continue to make money to the upside. And how much can you make more to the upside? Well, that's $32 and a half. Let's just say 32. So 32 times 100 is $3,200. So you're going to make another 3,200 if it jumps up to here.
Yeah, I mean,
On
even if
top
it
of
goes
this,
back up to the 150, which now
you're
I'm,
still going to be
yeah,
paid. You're still going to make
yeah,
money.
yeah.
So this is what I would do if I did not want my shares to be called away, because it's basically like it's being sold away in 4 days, and then you're coming back in and you decide that you're going to go to the 15 delta.
Hmm.
You don't win or lose in that situation yet. It all depends on what happens after that. And since a covered call is bullish, if it goes down, you're going to lose. If it goes down a lot, you're going to lose. It's not going to be a realized loss, but you will be losing. You will have an unrealized loss, I should say. If it goes up, because it's the covered call is a bullish strategy, you're going to be making more money.
Hmm.
So it's just repositioning the trade, making sure you do not get your shares sold. And so I like to tell people it's almost a 0% chance your shares are going to be sold away if it's out of the money, if your call is out of the money.
Hmm.
If your call is in the money, it's still closer to zero than five. It's going to be called away, but the risk has increased. And so your premise is you do not want your shares to be sold away. So what do you do then? You move it. The closer you are to expiration, the higher probability your shares are going to be sold away. Yours haven't been sold away yet, Dr. Sophie, but it might happen this evening. It might happen, tomorrow. It might happen before Friday because it's only 4 days to go. But you're in a 94 delta and you still haven't been sold away yet. So as I like to say, it's still closer to zero than 5% that your shares are going to be called away. I know a number of you had your shares called away soon and early, but statistically, it's still closer to zero than five that you're going to get called away before expiration.